We are now with Chief International Economist at ING Bank, Rob Carnell, to really get his thoughts and insight into this, perhaps arguably the biggest challenge facing the US economy right now. Thank you very much for speaking to us, Robert. Economists raising their forecast for US jobs growth this week. What are you looking for in the upcoming jobs report? What do you think we're going to see?
Well, our best guess, and it's only ever a guess with payrolls, it's such unreliable data, is that we'll get something of the order of about 210,000 jobs created this time, so a big pickup from last month. And we've obviously got some support, some encouragement from the ADP figures and the initial claims numbers that have been coming out over the course of the last month.
And everyone bumping up their numbers because of that ADP report you mentioned. Is the optimism justified? I mean, correct me if I'm wrong here, but I understand that in the November data, people that raised their forecast because of the ADP that month turned out to be wrong, didn't they? Oh,
completely, yes. I think if we look back at November, that November payrolls report does look like something of an aberration. You know, it was unbelievably weak compared to all the other data that was coming out at the time. So I don't think you can always look at the ADP and go, well, that's going to give you a great indicator of where payrolls is going to go. But at the same time, it's probably the least worst of a lot of very, very bad indicators of payrolls, and I don't think we can fully ignore it. It won't come in as strong as ADP, but it does give us some optimism that it'll be a fairly decent figure, and that there's scope perhaps for some payback from November's very weak payrolls figure.
So what about the pace of jobs growth in the coming year, Robert? Will we see the job market improving enough to bring down unemployment?
Well, if it comes out at anything like the sort of the consensus figure, 140,000 or above, that would be just enough to stabilise the unemployment rate. Anything above that, and you would start to gradually get the unemployment rate down. But it's not going to happen overnight. It's going to be a very slow process. And actually, if we are at the cusp of a pickup in job creation, one of the things we probably should expect is a return back into the labour market for people who've been disaffected by their job prospects, or the prospects of actually getting back into work. We could even see the unemployment rate rise a little bit further before things start to come down. That shouldn't worry us. It's a sort of inevitable denouement of things actually getting better, but we could head back into 10+% levels of the unemployment rate before things start actually improving.
What about Fed Chairman Ben Bernanke, Robert? He's got to testify on Friday justifying QE2. Could a potential stronger non-farm payrolls figure, a stronger labour market, perhaps make his job more difficult?
It does. I mean, I think the justification for QE2 was always a little tenuous from the outset. Pretty much from the moment that QE2 was put onto the statute books and started to be implemented, the data started to recover quite a lot more. So it does look harder to justify. I think there are people out there who believe that there's scope for either the project to be scaled back in terms of the scope of treasuries that are actually bought, so maybe falling a little short of the 600 billion that have been allotted to this programme, or maybe ending a little bit earlier with pretty much the same results. So that's something he'll have to fight against. If the data comes in strong today, it's going to be a harder battle to justify what he's doing.
Robert Carnell, Chief International Economist for ING Bank, thanks so much. Good to get your thoughts. Up next.